Emerging markets have experienced some turmoil recently due to market jitters over the Fed increasing interest rates, which could affect financing for many emerging economies. On top of this, emerging markets have accumulated high amounts of debt during the pandemic, which also has raised the potential for defaults. With me in the Finews studio today is Vontobel's Luc Dorge, who heads emerging markets fixed income at Vontobel. Good morning, Luc.
Good morning, Jade.
So, Luc, can you tell me what's behind the sell-off in emerging market debt that we've seen so far this year?
Mainly inflation surprises and the reaction of developed market central banks due to that. So that reacted in a big correction of US treasuries. And of course, you have the mechanical effect. EM, especially external debt, is just a spread product above EM treasuries. And the correction we've seen was mainly mechanical. So 95% of the correction can be explained by the treasury move. But once you have got these surprises, once really the tightening cycle starts, EM tends to perform very well, especially in 99 and 2004. We had like a spread contraction of 200 basis points, and even yields in EM dropped 100 basis points. Last one was with flat yields, but still good performances.
Good. And how are different market segments affected?
When you look into detail, you really see very interesting observations. You can see that EM external debt did perform not so good. Local was much better, and normally local is more affected by such a start of rate hikes. Probably they were much better because they were much more anticipative and already increased rates to a very, very big extent. And on the other side, in detail, on external debt, investment grade did correct more than anticipated by the treasuries, while high yield did do much better. You have much wider spreads, and even we saw a spread contraction on high yield.
And how will the Fed rate hikes affect emerging market debt issuers?
Well, you get a bit more competition of higher yields in the treasury market. That means it's harder to refinance yourself, probably. But you must see, really in that period, EM can do very well. What helps them is, as you said before, what doesn't help them is that the debt levels did increase during the pandemic. It did increase much less than for the developed world. That's one observation, very important. Their financing cost hardly did change during the pandemic. And what's very good is that their debt tends to be quite long. They don't have too much refinancing to do. It means that probably the refinancing is for a limited amount and won't affect their financing cost too much.
And should emerging market investors be concerned about inflation? Is there anything they can do about it?
Inflation is indeed where we can expect the surprises. They can be positive, they can be negative. Maybe we are already post peak inflation. Inflation also affects emerging market countries more, like food inflation is a big part of their spending and can result in social unrest and make it harder to implement strategies. But therefore, I think it's so important that EM central banks were so proactive in fighting inflation. So coming into potentially different period, we are much better prepared for that.
And can you tell me what makes Latin American and African emerging markets attractive at the moment?
We like those markets really a lot right now. I think for Africa it's since quite long, but we have seen recently a correction while commodity prices are rather high. So really they remunerate you very, very well for the risk that you take. While in LATAM, it's more recently. Election jitters, new governments, they don't perform really, or they don't give you what most investors wanted, but I think there was really an overreaction there. Curves are very steep, and I think there are really nice opportunities in those markets. So what you can do as an investor is going really for the long end of EM within these steep curves and hedge partially your duration by selling US treasuries, for instance.
Thank you very much for coming into the Finews studio today. We look forward to speaking to you again soon.